It's been quite a rough ride for Indian equities lately, hasn't it? The market has seen a 5-day decline and both the Sensex and Nifty have dropped by more than 3%. Today, as we're having this conversation at 1 p.m., the market has already lost about 1%, extending to a 6th day of decline. Adding to this, over the last 1 month, the benchmarks have almost lost about 4%. Now, what are the reasons behind this? Well, the number one factor currently affecting the market is the ongoing Israel-Hamas conflict. Now, this conflict has entered its 20th day and unfortunately, there doesn't seem to be a clear solution in sight. Now, this uncertainty in the Middle East region due to this conflict is causing some anxiety around investors. Now, the situation in the Middle East hits India particularly hard because the country heavily relies on oil imports. As the Middle East conflict escalates, it often disrupts oil supplies and causes global oil prices to shoot up. For India, where about 85% of our crude oil demands is met through imports, the surge in crude oil prices is a red flag. Now, if this uptrend in crude oil prices continues due to the Middle East tensions, it could spell trouble for India's inflation. Now, if you're interested in a more in-depth analysis of how the Israel-Hamas conflict is impacting the Indian stock market, you might want to watch our coverage on this on our Third Empire. Now, it could provide you with a more solid understanding of the situation. Now, coming back, another factor causing turbulence in the market is the surge in bond yields, with the 10-year Treasury yields hitting a 16-year high of 5%. This marks the highest level since July 2007. Now, when yields in the United States rise to such levels, they tend to be like a magnet for foreign portfolio investors who are always on the lookout for better returns on their investments. As a result, FPIs have been moving their funds away from emerging markets like India and towards the US. This shift has triggered an outflow of foreign capital from Indian equities. So, to put things into numbers, in October 2023, foreign portfolio investors have sold stocks worth a significant 9,935 crores so far. But do know, FPIs have still remained net buyers of Indian equities this calendar year of 2023. We see that the uncertainties stemming from the Israel-Hamas conflict, rising bond yields, rising crude oil prices, as well as continued foreign investor outflows are currently exerting pressure on the Indian markets. Now, it is essential to keep these market challenges in perspectives, but historical trends shows us that various crises, including geopolitical tensions, regional conflicts, usually have a temporary impact on financial markets. It's also important to note that global agencies have expressed positive views on India's economic prospects. Yesterday, a S&P report predicted that India, currently the world's 5th largest economy, is poised to become the 3rd largest by 2030, surpassing Japan. Last week on a Friday, Morgan Stanley upgraded India to a standout overweight status, considering it their most preferred emerging market. 2 weeks ago, CLSA, a global brokerage firm, also upgraded India to overweight and increased its India portfolio allocation. A month ago, Nomura, another global brokerage firm, upgraded India from neutral to overweight, citing a strong top-down narrative and the potential benefits of the China Plus One theme. Now, while Indian equities face short-term challenges, these positive assessments do highlight the positive outlook for India's economic growth and its appeal to global investors. Having said that, this is me, Merlin Sana, signing off. Take care and stay invested.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com.